We live in a time when there is a constant flow of information to us in the form of pop-ups on our mobile screen, and at times within seconds of an event happening. This constant flow of information can result in you getting into a mode where you are constantly reacting to the information that is being fed to you, especially with respect to the portfolio of investments that you have. To protect your portfolio from such adverse reactions, let's talk about the 3 mistakes that you must avoid, especially in a downward market like today. Hi, my name is Harshvardhan Dawar and I am the founder of Wealth Cafe, where we help you make smart money decisions. The first mistake that you need to avoid in a downward trending market is do not panic sell. It's very easy to react to the constant flow of negative information all around you and sell a stock which can actually be a winner for you in the long term. Let me explain this with the example of the paints industry. In the past few months, the prices of crude have gone up, and crude oil forms a major cost of manufacturing for the paints industry because that is a major raw material that is used to manufacture paint. So when you see that the crude prices go up, it will definitely have a negative impact on any of the paint stocks that you hold. But it's very easy for you to amplify the negative news and take a decision to sell all the paint stocks that you hold. An increase in the crude price is definitely going to be negative for a paint stock company, but what you need to sit back and analyze is this increase in the crude price permanent? If it is a temporary increase, there is no reason you must be panic selling your stock. Second, you also need to see that if at all the crude price is a structural change and it's going to stay higher for a longer period of time, how does it impact your stock? Does the stock that you own have the ability to pass on the price to its customers, or it does not have that ability? Depending on this analysis, you take a call on whether you should continue to hold your paint stocks, and you do not panic sell and exit all the paint stocks that you have just because the crude prices have gone up. The second mistake that you need to avoid is not selling your losers. If the market is correcting and you see that a particular stock that you own has started to correct, you need to know that is it correcting because of the general market factors, or is it correcting because of structural changes that have happened in the industry of the stock or in the stock that you own per se. Let me explain this with the example of Netflix. In the month of January, the company warned of the fact that they do not expect the growth in subscribers to be as much as they had anticipated in the past. So Netflix as a stock had run up and was at its all-time highs of around $680 per stock in the month of November. And when they warned of this particular growth not playing out the way it was anticipated, there was a correction in the stock and the stock fell from 680 to 380 levels. So if you are owning a stock in Netflix and you actually paid a very high price for Netflix in the range of 500 or 600 plus, anticipating a growth in the stock because of increase in the number of subscribers, when the company has warned that that is not going to happen, you need to go back and do a check of whether the company is worth how much you thought it was when you bought it, and if that is not the case, you must sell and exit the stock and not continue to hold on to your losses because there have been structural changes in the way the company functions and the kind of growth that they are seeing in their sales. The third mistake that you must avoid in a downtrending market is do not buy falling stocks. Just because a particular stock has fallen by 20 or 30%, it does not mean that automatically it becomes a good buy. Let me explain this with the same example of Netflix. Netflix corrected from 680 levels in November to levels of 360, 370 in the month of January. If you look at that stock afresh in January, you may think that it is a fantastic stock because it has fallen by over 50%. So if you go ahead and buy the stock just because it has corrected by 50%, well, today if you look at the value of stock, it is down another 50% and trading at levels of $180 per stock, resulting in an overall correction of 75% in a span of less than 3.5 months. So when you see a particular stock falling, do not buy it just because it has corrected 30 or 40%. Do your analysis, understand why the stock has corrected and whether it presents a value opportunity for you to buy or whether something has actually gone wrong with the stock and you should not be anywhere near the stock. To sum up, ensure that as an investor, you do not adversely react to the constant flow of information and take a very measured decision of what you must do. Do not panic sell and exit stocks which should actually go on to be your winners in the long term. At the same time, do not hold on to stocks which no more carry the story for which you bought into a particular stock. And finally, do not buy stocks just because they have corrected 30 or 40% from their all-time highs. For more such useful information on your equity investments, like, share and subscribe our channel for freshly brewed content every Wednesday and Saturday.